Imagine losing money on an investment that actually went up in value. Sounds impossible, right? But it happens to beginners all the time, and it's just one of over 100 small, repeatable mistakes that quietly drain wealth from new investors every single year. Here's the thing. Nobody sits down and decides to sabotage their own portfolio. These mistakes don't feel like mistakes in the moment. They feel like caution. They feel like excitement. They feel like common sense. But the data on beginner investor behavior tells a very different story. So today, we're not going to give you another generic list of tips. We're going to walk through the real patterns, the categories of mistakes that show up again and again, so you can actually recognize them before they cost you. Why should you care about this? Because most investing losses aren't caused by bad luck or a crashing market. They're caused by decisions that feel reasonable in the moment, but are statistically working against you. Think about it this way. The market itself has historically trended upward over long periods. So if the average beginner underperforms the market, as data consistently shows they do, something else has to explain the gap. That something is behavior, not the market, you. Before we go through the categories, let's set the foundation. Investor underperformance is actually a well-documented phenomenon. Research from firms like DALBAR has tracked what's called the behavior gap. For decades, the difference between the returns an index fund actually produces and the returns the average investor in that fund actually earns. That gap has often measured several percentage points per year, and over decades, that compounds into a massive difference in ending wealth. Think of it like a car with excellent fuel efficiency on paper. The manufacturer says it gets 40 miles per gallon, but the average driver, with all their stop-and-go habits, hard braking, and unnecessary detours, only gets 28. The car didn't change, the driving did. That's exactly what happens with investing. The market's engine works fine. It's the driving that costs people money. Now let's break these mistakes into categories, because that's the only way over 100 mistakes actually becomes useful instead of overwhelming. Here's the insight that ties almost all 100-plus mistakes together. Nearly every single one of them comes down to emotion overriding a plan. Not lack of intelligence, not lack of information. Emotion in the moment, beating out logic decided in advance. Once you see that pattern, the specific mistakes stop feeling random and start feeling predictable, which means they become avoidable. Category 1. Emotional and behavioral mistakes. This is the biggest category by far. It includes panic selling during downturns, chasing an investment after it's already gone up dramatically, checking your portfolio multiple times a day, letting a single bad month trigger a complete strategy change, and refusing to sell a losing investment out of stubbornness, often called loss aversion. It also includes the opposite, selling a winning investment too early out of fear of losing the gains, which frequently leaves far more money on the table than the loss it was trying to avoid. Category 2. Diversification mistakes. Beginners often put too much money into a single stock because it's exciting or familiar, often their own employer's stock, which combines investment risk with job risk in a dangerous way. Others chase whatever sector performed best last year, essentially buying high based on recent performance rather than future potential. And some beginners think they're diversified because they own 10 different tech stocks, when in reality they're all correlated and will likely fall together in a downturn. Category 3. Fee and cost mistakes. Small percentages sound harmless, but a 1.5% annual fee versus a 0.05% fee compounds into a massive difference over 30 years, sometimes tens of thousands of dollars. Beginners also frequently overtrade, generating unnecessary transaction costs and, in taxable accounts, unnecessary tax bills from short-term capital gains, which are typically taxed at higher rates than long-term gains. Category 4. Psychological traps. This includes overconfidence after a few lucky wins, which leads to bigger and riskier bets. It includes anchoring, fixating on the price you originally paid for something instead of evaluating it based on its actual current prospects. And it includes herd mentality, buying something purely because everyone online is talking about it, without understanding what it actually is or why its price moved. Category 5. Structural and planning mistakes. Not having an emergency fund before investing. which forces panic selling investments during a personal financial crisis. Investing money needed within 1 to 2 years into volatile assets, when that money should be in something stable. Ignoring asset allocation entirely and not rebalancing a portfolio as it drifts away from its original target over time. Category 6. Information and research mistakes. Taking investment advice from social media influencers or anonymous forum posts without verifying credentials or incentives. Confusing a company's popularity or brand recognition with the actual financial health of the business. And relying entirely on past performance to predict future results, even though virtually every prospectus and fund disclosure explicitly states that past performance doesn't guarantee future returns. Add up the specific variations within each of these 6 categories: different asset classes, different emotional triggers, different fee structures, different platforms, and you genuinely land well past 100 distinct, documented mistake patterns beginners fall into. But almost all of them trace back to one of these 6 root categories. The behavior gap research from DALBAR's long-running quantitative analysis of investor behavior has repeatedly found that average equity fund investors have underperformed the S&P 500 itself by several percentage points annually over multi-decade periods, a gap driven overwhelmingly by mistimed buying and selling rather than fund selection. Separately, research from Fidelity analyzing their own account holders found something almost darkly funny. Some of the best performing individual accounts belonged to investors who had either forgotten they had an account or had passed away, meaning literally nobody was actively managing or emotionally reacting to the account at all. The accounts that were left alone, untouched by panic or excitement, often outperformed actively managed ones. That's not an argument for ignoring your finances entirely. It's powerful evidence for how much damage frequent emotional intervention actually does compared to a steady, boring, consistent plan. Now, I want to be fair here. Not every deviation from just buy an index fund and never look at it is automatically a mistake. Some investors have legitimate reasons for more active strategies, higher risk tolerance, or specific tax and estate planning needs that go beyond simple index investing. And beginners shouldn't beat themselves up over every mistake on this list. Almost every experienced investor has made several of these at some point: panic, sold once, chased a hot stock once, checked their portfolio too obsessively during a rough month. The goal isn't perfection. The goal is reducing the frequency and severity of these mistakes over time, because even cutting the behavior gap in half can mean a dramatically different outcome by retirement. So how do you actually avoid falling into these patterns? A few concrete steps. First, write your investment plan down before you need it. How much you'll invest, how often, what you'll do if the market drops 20%. Decide this while you're calm, not while you're scared. Second, automate your contributions wherever possible. Removing the decision from your hands removes the opportunity for emotion to interfere with it. Third, diversify broadly rather than concentrating in whatever feels exciting right now. A simple, diversified index fund avoids the vast majority of the diversification and information mistakes on this list in one single decision. Fourth, check your portfolio far less often than you think you should. Data suggests that investors who check frequently make more emotional decisions than those who check quarterly or annually. This is exactly why the biggest edge in investing usually isn't picking better stocks, it's avoiding the 100 small, repeatable ways people sabotage themselves without realizing it. If you recognized yourself in even a couple of these, that's completely normal. Now you know what to watch for. If you enjoyed the video, please like and subscribe, and I'll see you in the next one.